Like it or not, credit reporting has become a fact of modern life. In this presentation, we'll take a brief look at how credit works, and then give you a few tips and tricks to make it better. Any credit can be fixed in time with diligent financial habits. Most people don't even understand what a credit score is. The credit score is nothing more than a formula that is trying to predict whether or not you are going to become 90 days late or more on a particular account over the next 2 years. The higher the score you have, statistically, the less chance there is you are going to pay 90 days late in the next 2 years. Although high interest rates seem unfair, there's actually a reason for them, because the person that may pay 90 days late, you have to pay for them. FICO scores range from a theoretical low of 300 to a high of 850. A credit score is made up of 5 components. The most important, payment history, which is 35% of the credit score. The balance that you carry in relation to the limits on revolving accounts is the second most important factor and is 30% of the credit score. The average age of the credit file on your report is 15% of the credit score and is the third most important factor in determining the score. The final 2 factors, which are both 10% of the credit score, are the mix of credit you have on your credit report and how many times you have inquired for credit. Let's talk about these different components in detail. Payment history is based on paying your bills on time and is agreed. As long as you pay your bills on time, don't get sued and have a judgment entered against you, and don't have a lien put on your credit report, you're going to do very well in this area. The good thing about payment history is when you do make mistakes and pay bills late or have judgments and collections put on your credit report, time does heal in this area. So a collection from 3 years ago is going to hurt your credit score a lot less than a collection that just came on last week. The first 2 years of a negative item showing as far as your payment history goes is what is going to hurt your credit score the most. Although a negative payment history, even if it's 5 years old, is still going to hurt your credit score, after 2 years, the significant effect it does have is reduced tremendously. The second portion that makes up your credit score are your revolving balances as they pertain to the limits. Usually this deals with your credit cards. Being that this component makes up 30% of your credit score, it is best to keep your debt ratios very low. Here's an example. Say that a borrower has 2 credit card accounts, and both accounts have credit limits of $10,000, but one is maxed out and the other has a 0 balance. In this case, the borrower has a 50% debt ratio. A good thing to keep in mind is the credit score likes to see the debt spread evenly, so even if the borrower does not pay a dime, but just moves the money around, the credit score is going to go up. The best way to maximize this area of the credit score, though, is to keep your debt ratios as low as possible. If you owe $20,000 on your credit cards and you have $50,000 in limits, you would want to pay that as close to 0 as possible to maximize your credit score. Never, ever close a credit card, though, once you pay it off. That hurts you a lot more than it helps you. It is important to note that mortgage or installment loans do not require the same approach as credit cards and revolving accounts. They have much less of an impact when they are maxed out towards their limit compared to the revolving accounts. So if you have a mortgage that is maxed out, it's not hurting you that much at all. But if you have a credit card that's maxed out, it's hurting you tremendously. The third component that makes up your credit score, which is 15% of the score, is the average age of the credit file. The older, the better. One thing I've seen all 800-plus credit scores have in common is very old credit cards and low balances. If you want to have the highest credit score possible, you should never close your credit cards you currently have for this reason. If you close your credit card, your 10-year-old credit card is not going to have its 11th birthday next year, and therefore the average age of all your files combined is going to be less than if you would have left it open. Closing that credit card will also increase your debt ratio. The fourth factor of your credit score is 10%, and that is the mix of accounts you have on your credit report. The credit score likes to see between 3 and 5 revolving credit cards, 1 mortgage account, and 1 auto loan. Now, if you have more than 3 to 5 revolving credit cards, as I said before, do not close your credit cards to get down to that number. It's not going to help you that much. It will hurt you much more than it will help you. I've seen people with 780 credit scores have 15 credit cards, as long as the credit card does not have a lot of money owed compared to the limits. But if your whole goal in life is to have the highest credit score possible when you're starting from scratch, then you should probably stop getting credit cards in between 3 and 5 credit cards once you have that many. Let me mention a few things about a home equity line of credit that you should be aware of. A home equity line of credit, unfortunately, is treated as a big credit card by the credit score. So if you take out a $100,000 home equity line of credit on your home, the credit score is going to look at that like it's a $100,000 credit card. Now, it's not bad that you have $100,000 of available credit. It's not that that's hurting you. But if you borrow the whole amount, your debt ratio will be considered very high and your score will hurt as a result. Therefore, if you do want to get a home equity line of credit, I suggest that you get a home equity line of credit for a lot more than what you really need if you're able to. For example, if you only need $30,000 to do an addition on your home, but you have enough equity in your home to get approved for a $200,000 home equity line of credit, the credit score will interpret that as though you're only using 15% of that available credit, and your credit score is not going to be hurt as a result. The inquiry portion of your credit score makes up 10%. How many times did you actively seek credit? If your credit is run too frequently, the risk that the borrower might default on payments is higher, and therefore the score drops. First, if shopping around for a mortgage or a car, the credit score treats mortgage and auto inquiries, all made within a 45-day period, as one as far as credit scoring purposes go. Credit cards, on the other hand, if you apply for 10 credit cards today, you have 10 inquiries that are hurting your credit score. Now, inquiries, they stay on your credit report for 2 years, but the credit score only penalizes you for the inquiries made in the past 12 months. We've taken a look at how credit works. Next, let's take a look at how to improve or fix your credit. If you're considering buying a home or refinancing, discuss the timelines required to repair your credit with your mortgage professional. Fixing or improving your credit can be broken down into a few categories: credit coaching and credit correction. Coaching entails things you can do yourself and often see very fast results. Correction takes a minimum of 45 days and often many months or even years. Credit coaching involves a few steps. First, pay any past due accounts that are showing on your credit report, other than charge-offs and collections, which always show as being past due. That's a whole different story. But if you have mortgage accounts or credit cards that you're 30, 60 days behind on, and there's a past due balance showing, the past due balance is hurting your credit score significantly, not to mention the fact that the 30-day late payments getting added are hurting too. But the credit score does look at the past due column, and when it sees that there's a past due amount owed, it will hurt your score as a result. Keep in mind, you don't have to be 30 days late to be past due. If your mortgage is due on the 16th of every month and you always pay it on the 28th because the penalty doesn't kick in until the 1st, you're actually past due on the 17th, the very day after the mortgage was due. Although you always pay it before it's 30 days late and you never get a 30-day late payment showing on your credit report, you're still past due during those 12 days. The problem is a lot of lenders will report the fact that it's past due the very next day after the due date, and they'll take it off once you pay it. But if you're in the process of getting a refinance, you can actually have the credit report pulled with the past due balance shown, and your score may end up being lower than what's needed to get approved. Therefore, it's a very good idea and very important that you pay your bills before the due date to keep this from happening. The past due accounts do not include judgments, collections, and charge-offs. Those are always past due until they're paid to zero. It is best not to pay these types of accounts right before you're getting a mortgage, because the problem is a lot of the times when you do pay them, the lender that actually had the money owed to them will update the credit report to show paid collection or paid charge-off. When that happens, sometimes they also make the date of last activity the current date when they change it to paid. The credit scoring software looks at that as though it was a recent collection or a recent charge-off, even though the only thing you did was pay it. And as a result, your credit score goes down tremendously. I'm not saying you shouldn't pay these types of accounts. I'm simply saying that when you are in the process of getting a loan, you should maybe wait until after the loan closes or pay it concurrent with the closing in order to prevent yourself from falling into that trap if it is going to end up hurting your credit score. Increasing the credit limits can increase your credit score. Every 6 months or so, you should call your credit card companies up and request that they increase your credit limit. Ask them if they'll do it based on your good payment history with them and not pull a hard inquiry. Most of the times they will say no, but sometimes they'll say yes. The whole catch-22 of this is you do have to get an inquiry sometimes and hurt your credit a little bit for the greater good of your credit score in the future. This is not something I would do right before a mortgage, but if you're not planning on getting an auto loan or a mortgage in the next year, that's a good time to call your credit card companies up and ask for a credit limit increase. The effect the inquiry has on your credit score is not going to really matter because you're not buying anything. But the benefit you will get by your credit limit being increased is going to help out your debt ratio. Your debt ratio will decrease as your limits increase. Remember,